Welcome to the Great Debt Debate. In this video, we will unpack why many high earners rush to eliminate student loans while keeping 30-year mortgages, even when interest rates look similar. We will move step by step through risk profiles, tax treatment, cash flow flexibility, and strategic planning. Stay with me as we build a clear framework and finish with a practical plan and interactive quizzes. Here is the roadmap. First, we define the paradox. Next, we compare risk versus rate. Then, we explore why student loans are uniquely sticky and how mortgages differ. After that, we examine cash flow and loan qualification impacts. We will then outline a practical strategy, test your understanding with quizzes, and close with key takeaways and next steps. At the surface level, equal interest rates should lead to equal urgency. However, we tend to attack student loans aggressively while tolerating a 30-year mortgage. The root cause is not the nominal rate. It is the underlying risk, optionality, and exit strategies available. Student loans impose lasting constraints, whereas mortgages build equity and offer multiple exits. Let us compare the risk characteristics. Student loans are difficult to discharge and may follow you into retirement through mechanisms like wage or benefit garnishment. They are unsecured, and you cannot liquidate the underlying asset because the asset is your education. Mortgages, by contrast, are secured by a tangible asset. Each payment increases equity, and there is an exit path through selling or foreclosure. Tax treatment differs as well. Mortgage interest is frequently deductible, particularly early on, while student loan interest is limited and often phased out for high earners. Eliminating student loans increases optionality by freeing cash flow to qualify for additional loans, bolster retirement accounts, and pursue investments. Strategically, when debts share a rate, the one with higher permanence and fewer protections should be prioritized, which typically means student loans. Side by side, student loans are unsecured, highly persistent, and lack an asset that can be liquidated. They pose risks such as wage or benefit garnishment and offer limited tax relief. Mortgages are secured by property, build equity with each payment, and provide several exit options, including sale or refinance. They may carry broader tax benefits, and their long payoff horizon better matches the lifespan of the asset. This flowchart begins at the debt type and splits into student loans and mortgages. The student loan branch highlights that the debt is unsecured, there is no asset to sell, and discharge through bankruptcy is rare. It then shows the possibility of wage or Social Security garnishment, culminating in a high permanence classification and a strategy to pay off quickly. The mortgage branch emphasizes that the debt is secured by a home, payments build equity, and in a crisis you can sell, or the lender can foreclose, resolving the debt. This supports a strategy of paying on schedule, or refinancing, rather than rushing to eliminate it. Tax mechanics alter effective cost. Mortgage interest is frequently deductible, particularly in the early years when interest dominates the payment. Student loan interest deductions are limited and phased out with higher incomes, which means many high earners receive no benefit. Consequently, equal nominal rates can conceal different after-tax costs, making mortgages cheaper than student loans on an after-tax basis. This pie chart illustrates how mortgage payments often include a significant interest component that may be deductible, alongside principal and other housing-related expenses. In contrast, the student loan interest slice highlights the non-deductible nature for many high earners due to phase-outs. The goal is to visually reinforce that the after-tax cost structure favors mortgages. Eliminating student loans frees monthly cash flow, which immediately lowers your debt-to-income ratio. This improves the likelihood of approval for additional credit, such as a second mortgage. The freed cash can be redirected to retirement accounts, health savings accounts, and taxable investments, while also strengthening your emergency fund and overall risk protection. Here is a step-by-step approach. First, establish a 3 to 6 month emergency fund to prevent new debt during setbacks. Next, list all debts with balances, rates, terms, and tax treatment. Then, prioritize high-risk student loans for accelerated payoff, especially those without a viable forgiveness path. Consider income-driven repayment or public service loan forgiveness if eligible, optimizing these before making prepayments. If refinancing, proceed carefully to avoid losing federal protections. Keep the mortgage on its normal schedule and refinance only when it improves after-tax cost or term structure. As student loans are eliminated, automatically increase retirement contributions and invest the surplus. Finally, Update your insurance and estate planning to align with improved cash flow. This timeline lays out a staged journey. Initially, build the emergency fund. Over years 0 to 2, aggressively pay down student loans. Around year 2, the reduced debt-to-income ratio supports better loan approvals. From years 2 to 5, maximize retirement accounts and build taxable investments. Beyond year 5, maintain the mortgage schedule or refinance if it improves terms. Throughout, rebalance investments and review insurance coverage. Quiz time. The question asks, which core factor justifies prioritizing fast payoff of student loans when rates are equal? Option A is lower minimum payments on student loans. Option B is higher tax deduction on student loans. Option C is greater permanence and unsecured risk of student loans. Option D is better appreciation potential of education. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. The greater permanence and unsecured nature of student loans, along with potential garnishment and lack of a liquidating asset, make them the higher risk obligation to eliminate first. Second quiz. The question asks, which benefit is more associated with mortgages than with student loans for high earners? Option A is broad interest deductibility. Option B is guaranteed forgiveness after 10 years. Option C is immunity from foreclosure. Option D is the ability to sell the underlying asset. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is D. Mortgages are secured by a home, which can be sold to resolve the debt, providing an exit strategy. Additionally, mortgage interest often yields broader tax benefits than student loan interest for high earners. This table shows a hypothetical example of the impact of eliminating student loans on the debt-to-income ratio. Before payoff, monthly debt obligations total $3,200 on a gross monthly income of $12,000, resulting in a DTI of approximately 26.7%. After eliminating $1,200 of student loan payments, monthly debt falls to $2,000, while income remains the same, dropping DTI to roughly 16.7%. This materially improves borrowing capacity. This section debunks common misconceptions using a myth versus fact format. First, equal nominal rates do not imply equal priority because dischargeability, risk, and tax treatment differ. Second, prepaying a mortgage is not always superior to investing due to after-tax costs and opportunity cost. Third, forgiveness programs are not universally available and require careful eligibility assessment. The rule of thumb is to eliminate the most permanent, least protected debt first, which is typically student loans. To summarize, equal rates do not imply equal risk. Student loans are sticky and unsecured, which supports prioritizing their payoff. Mortgages build equity and offer exit strategies. After-tax calculations frequently favor mortgages. Eliminating student loans increases free cash flow, improving approvals, and enabling investment. Follow a staged plan beginning with an emergency fund, then student loan payoff, followed by increased investing and targeted mortgage optimization. This content is educational only and does not constitute financial, tax, or legal advice. Viewers should consult qualified professionals who understand their personal circumstances before making any decisions. Thank you for watching. If you found this helpful, please like the video, share it with someone who might benefit, and subscribe for more content. In the comments, share whether you prioritize student loan payoff or prefer to ride the mortgage schedule and why.